Have you ever wondered why people who reach $1 million invested seem to enter an entirely different financial reality almost overnight? It looks mysterious from the outside, yet the transformation becomes surprisingly logical once you understand how money behaves at scale in the real economy. Most people assume millionaires simply work harder or earn higher salaries, but the real difference comes from how their capital begins working independently. There is a threshold where money stops being something you chase every month and begins becoming something that quietly supports your entire lifestyle. Today, I want to show you exactly why that threshold begins at $1 million invested rather than earned or counted as net worth. My name is Max, and I have spent years studying financial patterns, observing investors, and analyzing how people behave once they cross major wealth milestones. What I discovered might reshape how you think about your long-term future because it reveals a financial shift most people never see coming. This shift is not about luxury lifestyles, but about entering a new financial category where your capital finally outperforms your labor consistently. Most people underestimate how dramatically the rules change because they imagine wealth growing in a simple, linear, predictable fashion forever. But real wealth does not grow linearly. It jumps in stages, and the $1 million mark is the first major leap that changes everything. To understand this clearly, we need to look at some updated numbers that explain how American households actually live and spend today. According to recent Census Bureau data, the median American household earns around $83,000 per year before taxes and deductions. Meanwhile, household spending averages roughly $77,000 annually, leaving very little left over for meaningful investing or long-term security. This tiny gap explains why so many Americans feel financially stuck, because saving your way to freedom is nearly impossible under these conditions. When your income barely exceeds your expenses, you remain trapped exchanging time for money without building meaningful financial momentum. But when you finally reach $1 million invested, the math immediately flips and begins working overwhelmingly in your favor. Let me show you why using a simple and widely accepted assumption. Long-term stock market returns average around 6 to 7% annually. These are conservative numbers supported by decades of performance from indexes like the S&P 500, including dividends and reinvestment. If you invest $100,000 at a 7% annual return, it produces around $7,000 in passive income each year. That amount is helpful but not life-changing, and certainly not enough to meaningfully reduce your dependence on a paycheck. See, with $500,000 invested at the same rate, you would generate roughly $35,000 annually without needing additional labor. This begins creating breathing room, but still does not fully cover the cost of an average American lifestyle. However, when you reach $1 million invested, that same 7% generates about $70,000 per year automatically. That figure is incredibly significant because it nearly matches the annual spending of the average American household. This means your investments alone can theoretically support your basic lifestyle even if you decided to stop working tomorrow. Once your capital can pay your bills, your relationship with money stops being defined by desperation and begins being defined by choice. At that moment, you are no longer thinking like a saver. You begin thinking like a capital owner with new responsibilities and opportunities. Savers focus on gathering money while capital owners focus on protecting, optimizing, and allocating money for long-term stability. This sounds philosophical, but it becomes mathematically real the moment your investments start producing income comparable to your full-time salary. You shift from asking how much you can earn this year to asking how well your capital can continue performing without unnecessary risk. This shift also changes how you perceive market volatility because your portfolio grows large enough to create dramatic swings in dollar value. A 10% market drop with $20,000 invested costs only $2,000, which is uncomfortable but manageable. A 10% drop with $1 million invested costs $100,000, which can feel overwhelming when you first experience it. Seeing six-figure losses appear on a screen can be emotionally shocking, even when you intellectually understand the market will likely recover. But here's the surprising part. Once your capital generates enough income to support your lifestyle, market dips feel less like threats. They begin to feel like opportunities because you finally have the resources to buy additional assets at discounted prices. Wealthy investors understand this instinctively because they view volatility as a tool rather than something to fear or avoid constantly. When you have meaningful capital, you can endure market downturns without panicking, since your basic needs remain safely covered. That security fundamentally changes how you approach investment decisions because you are no longer reacting from a place of survival. Instead, you make decisions from a place of strength, patience, and long-term perspective, which typically produces significantly better outcomes. The psychological shift does not stop there because reaching this threshold also transforms your relationship with work itself. When your investments can theoretically cover your expenses, work becomes optional rather than mandatory for your continued survival. That does not mean you suddenly quit your job, but it means every professional decision becomes a genuine choice rather than an obligation. You can negotiate confidently, refuse toxic environments, and pursue opportunities that align with your interests instead of financial desperation. You can take career risks like switching fields, launching a business, or exploring new paths without fearing immediate financial collapse. This freedom creates a sense of calm that influences your overall well-being because your livelihood no longer hangs by a fragile thread. Your time becomes more valuable than your direct earning potential, leading you to prioritize meaning instead of constant financial output. You might choose to work fewer hours, take more vacations, or dedicate time to family without worrying about lost income. This transition marks the beginning of true financial independence, where your life choices are guided by purpose rather than paycheck anxiety. But the millionaire threshold also opens doors to investment opportunities that were previously impossible to access with smaller portfolios. Many high-quality investment opportunities require minimum commitments of $50,000 to $100,000, which are unattainable for smaller portfolios lacking substantial reserves. Once you have significant capital, allocating just 5% into these opportunities becomes feasible without exposing your entire financial foundation to unnecessary risk. This access dramatically accelerates wealth building because it introduces higher yield strategies that average investors never encounter during their early accumulation years. Banks also begin treating you differently because your asset base demonstrates stability, reliability, and long-term financial strength they actively prefer supporting. Loan approvals become smoother, interest rates often improve, and financial institutions start offering premium services usually reserved for affluent clients. For example, banks may approve investment property loans faster when you can show substantial liquid capital serving as credible collateral for repayment. Business acquisition loans, which often require proven reserves and large down payments, suddenly become realistic possibilities rather than distant fantasies. You also gain access to margin lending, allowing you to borrow against your portfolio without liquidating long-term investments during inconvenient market conditions. This creates a level of financial flexibility that average investors rarely experience because their resources remain too limited for advanced strategies. But reaching $1 million invested does not only unlock financial advantages, it also introduces unexpected psychological challenges many people never anticipate. When your portfolio is small, daily fluctuations might move a few dollars, or maybe a few hundred, which feels manageable emotionally. Once you hold a seven-figure portfolio, daily swings can exceed several $1,000s and sometimes reach tens of thousands, depending on market volatility. Watching your net worth rise and fall so dramatically can trigger intense anxiety, even when you logically understand market patterns long-term. Many new millionaires start refreshing their investment apps constantly, becoming emotionally tied to every upward or downward movement on the screen. This compulsive monitoring often comes from the shock of realizing your financial future now sits on a non-stop market roller coaster. Losing 5% with $50,000 invested means losing $2,500, which stings but does not alter your overall lifestyle. Losing 5% with $1 million invested means losing $50,000, which equates to an entire year of salary for many Americans. This reality introduces a strange emotional paradox, where greater wealth creates both greater safety and greater psychological vulnerability simultaneously. To manage this, many people begin shifting their portfolios toward more conservative allocations once they cross the millionaire threshold. They prioritize capital preservation over aggressive growth because the downside now feels more personally meaningful and increasingly difficult to ignore. Portfolio strategies that felt comfortable early on suddenly feel too risky when the actual dollar amounts become significantly larger. For example, holding 80% in volatile growth stocks might feel reasonable at $50,000, but overwhelming at $800,000. This shift towards stability is not just emotional, it is mathematically rational when protecting your financial foundation becomes the top priority. A 20% loss on a $1 million portfolio sets you back $200,000 and possibly years of slow rebuilding. Understanding this risk pushes many new capital owners to rethink how they manage their allocations and long-term strategies responsibly. Yet, despite these new anxieties, people who reach this milestone often report feeling more secure than at any previous point in life. This security comes from knowing your investments could theoretically support your lifestyle indefinitely, even during difficult economic periods. Job loss becomes less frightening because you possess years of potential living expenses growing quietly inside your investment accounts. Health emergencies become less catastrophic because you finally have resources capable of absorbing unexpected medical expenses without destroying your stability. Economic recessions feel less threatening because you understand that diversified assets generally recover and grow when given enough time. This creates what many call the optionality mindset, meaning your life becomes defined by choices rather than constant financial pressure. You gain the freedom to decide where you want to live without being forced into cheaper areas solely to reduce expenses. You gain the freedom to take jobs that align with your values rather than jobs offering the highest possible paycheck. You gain the freedom to pursue creative projects, personal goals, or entrepreneurial ideas without risking total financial collapse. The worst-case scenario for most risks becomes returning to your previous lifestyle while your capital continues generating consistent income. This psychological shift is incredibly powerful because it removes the constant fear that one mistake could ruin your future. Reaching the millionaire threshold also affects how you think about family, responsibility, and the impact your wealth can create over time. Having children becomes less financially stressful because you know your capital can help support their needs as they grow. Supporting aging parents becomes more manageable because you have reserves available for unexpected costs and long-term care situations. Taking extended time off work for major life events no longer threatens your sense of financial stability or long-term security. These changes create a stronger sense of control over your future, which is something many people spend decades trying to find. But perhaps the most surprising transformation happens when you begin understanding how capital compounds faster at higher levels. If your $1 million grows by 8% in a single year, you gain $80,000 without performing additional labor. That amount exceeds what many Americans contribute to retirement accounts across several years of disciplined saving and budgeting. This effect accelerates dramatically because the larger your base, the more aggressively compound growth multiplies your future wealth. The first million may take decades to build, but the second million often appears much faster thanks to this acceleration. Continued contributions combined with compounding returns create a flywheel effect where building wealth becomes significantly more efficient. At this stage, most capital owners begin focusing more on tax efficiency because small percentage differences now equal enormous dollar amounts. Strategies like tax loss harvesting, asset location planning, and optimized retirement contributions become valuable tools for protecting long-term gains. Wealthy individuals also gain access to more sophisticated financial advisors and services designed specifically for complex higher net worth situations. These services are not exclusive because they are luxurious, but because they become mathematically worthwhile once your portfolio reaches substantial size. When even small tax adjustments can influence tens of thousands annually, professional guidance becomes an investment rather than an unnecessary expense. But the most profound transformation occurs when you start thinking beyond yourself and consider the long-term legacy your capital can create. When you are building your first $100,000, every dollar feels essential because progress is slow and difficult to maintain. You celebrate small milestones because each step forward represents months of discipline and sacrifices that required meaningful personal effort. But once you reach $1 million invested, the scale of your financial thinking shifts from short-term survival to long-term permanence. You begin thinking about how your money will support your family, future generations, or charitable causes beyond your lifetime. This shift occurs naturally because your returns begin outpacing your spending, creating resources capable of lasting far beyond your personal needs. Instead of focusing on individual dollars, you start viewing money in terms of months or years of financial independence. A $10,000 expense no longer feels devastating because you understand your investments can replace that amount within a short time frame. This creates a sense of financial breathing room where unexpected costs no longer trigger fear or immediate emotional reactions. But the most counterintuitive part is that the wealthier you become, the more opportunity you have to generate even greater wealth. It often feels like financial systems contain secret levels that only unlock once you accumulate significant capital and stability. One example is leverage, which becomes far safer and more accessible once you possess meaningful liquid investments. With just $20,000, banks may view you as high risk and limit your ability to borrow effectively. With $1 million in liquid assets, banks treat you as a preferred customer with favorable terms and credit lines. You suddenly qualify for investment property loans that offer better rates, faster approval, and far more flexible borrowing structures. You can access business lines of credit based on your asset base, rather than relying solely on earned income. Margin lending becomes a viable tool for pursuing opportunities without selling long-term investments during unfavorable market periods. This access to efficient capital is one of the primary reasons wealthy individuals continue accumulating assets at accelerated speeds. They are not simply saving their way to wealth. They are using their existing wealth to acquire additional wealth-producing assets. Real estate becomes an entirely different game when you can offer strong down payments and prove significant liquid reserves. Deals that were once out of reach become approachable because you can act quickly and confidently when opportunities appear. Sellers and lenders favor buyers with substantial capital because they offer reliability and reduced transaction risk. Cash offers, bridge financing, and strategic acquisitions become realistic strategies instead of distant financial dreams. But perhaps the most powerful change is how you begin valuing your time differently once your investments consistently generate reliable returns. When you are working toward your first million, every unused hour can feel like a missed opportunity to earn additional income. You constantly evaluate whether hobbies, relaxation, or time with family are worth losing potential earnings from extra work. But once your capital creates consistent returns, your time becomes more valuable than the income you would generate working additional hours. This creates a shift where you prioritize meaningful experiences, personal development, and emotional well-being over maximizing short-term income. People around you may misunderstand these decisions because they still view time primarily through the lens of direct earnings. They may question why someone with $1 million would turn down higher-paying jobs simply to protect mental health. But this misunderstanding highlights the core difference between financial survival and financial freedom. When your basic needs are covered by passive income, your objective shifts from maximizing earnings to maximizing quality of life. Risk also changes in surprising ways because wealthy individuals often become more conservative with their primary portfolios. They preserve about 80% of their assets in diversified, stable investments that protect long-term security. They use the remaining portion for higher-risk opportunities that offer significant upside without threatening their overall foundation. This creates a risk tolerance paradox, where the people who can most afford to lose money become the most careful with core assets. Meanwhile, they become surprisingly bold with small allocations because the downside remains manageable relative to their total portfolio. This blended strategy allows them to maintain security while still capturing opportunities unavailable to those living paycheck to paycheck. Another unexpected shift occurs in personal relationships because discussions about money change dramatically once you possess substantial assets. You may hesitate to mention financial stress since your challenges differ from people still fighting to save their first $1,000. You may avoid discussing market losses because others might perceive them as luxury problems rather than genuine emotional experiences. You may feel isolated during financial conversations because your concerns no longer match the struggles of your social circle. This social gap surprises many new millionaires who expected wealth to solve problems rather than create new communication challenges. The lifestyle differences become even clearer as your financial mindset shifts toward long-term stability, while others remain focused on short-term survival. Yet, despite this isolation, you may also experience deeper confidence because your financial foundation finally feels solid and dependable. You gain the ability to support loved ones during emergencies without jeopardizing your own long-term stability. You gain the ability to make thoughtful decisions about housing, career paths, and family planning with far less anxiety. Most importantly, you gain the peace of knowing your future is no longer determined solely by the next paycheck or job opportunity. This peace of mind becomes the true benefit of reaching $1 million invested because it represents stability rather than simple numerical achievement. But the transformation extends even further when you consider how your financial decisions start shaping the opportunities available to future generations. You may begin planning how to fund your children's education without jeopardizing your long-term retirement security. You may consider creating trusts, wills, or structured estate plans that ensure your assets continue supporting your family responsibly. These considerations become increasingly important as your wealth compounds faster than you can reasonably spend during your lifetime. This is when many people begin viewing themselves less as wealth accumulators and more as responsible stewards of long-term capital. Stewardship means managing money carefully not only for personal benefit, but also for the well-being of others who depend on you. It also means making thoughtful decisions that balance generosity, prudence, stability, and long-term sustainability. Another powerful mindset shift occurs when you realize your investments function like employees working tirelessly on your behalf. They work 24 hours per day, 7 days per week, generating income while requiring no commutes, meetings, or managerial oversight. The more capital you possess, the larger your invisible financial workforce grows, and the more productive your overall system becomes. This understanding motivates many people to continue investing even after reaching their initial independence milestone. They realize each additional dollar invested expands their long-term earning capacity and strengthens their ability to weather economic hardships. Instead of viewing investments as numbers on a screen, they begin perceiving them as partners supporting their long-term goals. This mindset increases patience because you focus less on short-term fluctuations and more on long-term outcomes that truly matter. Patience becomes a major advantage as markets commonly reward consistent, long-term investors more than emotional short-term traders. With substantial capital, you gain the freedom to ignore short-lived market noise that often distracts inexperienced investors. You stop panicking during downturns because you understand declines often present discounted opportunities for disciplined buyers. You stop celebrating every market rally because you know long-term consistency matters more than unpredictable daily volatility. This emotional stability becomes a key component of financial independence because it prevents destructive, impulsive decisions. Another profound change occurs when you realize wealth is not about escaping work, but about choosing work that brings meaning. You may shift from high-pressure environments toward roles offering fulfillment, creativity, community impact, or personal satisfaction. You may choose opportunities where you feel valued rather than opportunities offering the highest compensation packages. You may even rediscover hobbies or passions that were neglected during years spent chasing financial security. This shift reflects a deeper truth. Real wealth is measured in freedom, not material accumulation or external validation. Freedom gives you time to travel, learn new skills, or spend uninterrupted moments with people you truly care about. It gives you time to rest, breathe, and reflect, without the constant pressure of financial survival looming overhead. You may realize your most valuable resource is no longer money, but the time your money has now returned to you. This realization permanently changes how you evaluate opportunities, because you begin measuring them through the lens of life satisfaction. Suddenly, stressful jobs with toxic cultures become unattractive regardless of compensation because they cost too much emotional energy. Meanwhile, slower-paced or creative roles become appealing because they enhance well-being rather than diminish it for financial gain. This transition often confuses outsiders who still believe working harder is the only path toward financial improvement. But once you experience financial independence, you finally understand that maximizing income is not always the optimal life strategy. Instead, maximizing alignment between your values, goals, and daily experiences becomes far more meaningful and sustainable. Another unexpected shift appears in the way you evaluate risk across different areas of your life. When you are financially vulnerable, every risk feels amplified because the consequences can jeopardize your essential stability. When you possess substantial capital, risks feel more manageable because setbacks do not threaten your survival or long-term security. This enables thoughtful risk-taking in business, education, and personal development that previously felt too dangerous or unrealistic. Many financially independent individuals pursue entrepreneurial ventures once considered impossible because they now possess a meaningful safety net. Others explore creative careers, philanthropic work, or lifestyle changes that would have been irresponsible without strong financial foundations. This new courage stems from understanding that your future no longer depends solely on a single job or income stream. Instead, your financial ecosystem supports you through multiple channels, each contributing toward long-term security and flexibility. This diversification is one reason financially independent individuals feel safer, even when experiencing market downturns or career transitions. They know their foundation rests not on one paycheck, but on the consistent performance of a well-structured portfolio. This awareness reduces anxiety and creates a calmer, more deliberate approach to major life decisions. When you no longer fear losing everything, you begin choosing paths that reflect your authentic interests instead of external pressure. You stop feeling trapped by circumstances and start believing in your ability to shape your own life intentionally. This newfound agency often improves relationships because you interact with others from a place of confidence rather than financial stress. You become more generous, patient, and supportive because financial scarcity no longer dominates your emotional bandwidth. Ultimately, reaching $1 million invested marks the beginning of a new financial reality, where your capital finally works harder than you do. This shift marks your transition from someone who constantly pursues money to someone whose money consistently supports a life of freedom. At this level, financial decisions become less about necessity and more about designing a lifestyle aligned with your deeper priorities. You become more intentional about how you spend, invest, work, and allocate your limited time throughout each meaningful year. The pressure to constantly earn fades, replaced by a thoughtful desire to maintain stability while pursuing long-term personal growth. You begin recognizing that wealth is not measured solely by net worth, but by the quality of choices available to you. Every major decision feels lighter because financial independence provides a cushion protecting you from worst-case scenarios realistically. Even during uncertain economic cycles, your investments continue functioning as a reliable foundation, supporting your essential needs comfortably. This stability encourages introspection, helping you determine what truly matters when survival is no longer your dominant motivation. You may discover new passions, reinvent your career, or engage in opportunities previously ignored because they lacked immediate financial reward. This transformation explains why financially independent people often appear calmer, more patient, and more purpose-driven than before achieving stability. They have shifted from reacting to life circumstances toward intentionally shaping lives that reflect personal meaning and long-term vision. Reaching $1 million invested does not eliminate challenges, but provides the financial space required to solve them thoughtfully. It gives you room to adapt, experiment, fail, learn, recover, and continue progressing without catastrophic financial consequences. This resilience becomes one of your greatest assets because it empowers deliberate decision-making, even during uncertain or stressful times. You realize wealth's highest purpose is not luxury consumption, but the freedom to live life without constant financial fear. This understanding shifts your long-term strategy from accumulation towards sustaining a balanced and fulfilling life guided by intentional choices. You gain clarity about your future because your capital provides stability, optionality, and opportunities previously unavailable or unimaginable. Ultimately, the millionaire threshold is not just a number, but a gateway into a fundamentally different financial reality entirely. It marks the moment you stop trading time for survival and begin living with genuine autonomy rooted in strong financial foundations. If you're serious about building lasting wealth, understanding this threshold provides a roadmap showing what becomes possible once you finally reach it.